Hi, it's John Davis here with another tax saving tip for you. This week I want to talk about the end of the personal tax year. It's creeping up on us, the 5th of April 2015, and today I'm going to give you 5 tips on what you can do before the 5th of April to cut your personal tax bill. The first one, I want to talk about ISAs. Individual savings accounts, or ISAs, are a really tax efficient way of saving. Because all the interest is tax-free and any profit you make when you sell one is also tax-free. Now each year you can put £15,000 into an ISA, and that's the highest it's ever been, so it really is a good time to use them. But on top of that, don't forget your kids. You can actually put £4,000 per year into a junior ISA for each of your children. So what that means is, for a family of 4, you can put in £38,000 this year into ISAs, and all the interest and income is tax-free. The next thing I want to talk about is pensions. Again, pensions, very tax-efficient way of saving, and of course, you know, the government has a lot of incentives now to save for your future. Because on pensions, if you're a basic rate taxpayer, for every £100 that you put into a pension, the government will add £25. If you're 40% taxpayer, if you put £100 of cash into your pension, the government will add 67. And if you're a higher rate taxpayer at 45%, for every £100 you put in, the government will put £82 into your pension. Now, the limit for this year, the most you can put in with the tax relief on it, is £40,000. But if you haven't used your allowance for the previous years, you can go back up to 3 years. And the good news is, in those 3 years, the allowance is £50,000. So if you haven't put anything in for the last 4 years or so, you could put up to £190,000 into a pension this year, and the government will add tax relief to that. Okay. The third thing I want to talk about is capital gains tax. This is the tax you pay when you sell an asset. Now that asset could be a rental property, a car that you bought, an investment, it could be shares, those kind of investments, but these are taxed under capital gains tax, totally separate to income tax, and that's really the point in what I want to talk about, because each year you get a separate allowance for capital gains tax, where you can sell assets and make up to a profit of £11,000 tax-free. So if you are thinking of selling anything, and let's say you do have some investments or a rental property, it's worth thinking about the timing of that. If you haven't sold anything this year, and therefore you haven't used your £11,000 of tax-free income on the sale of assets, it's worth then thinking, if I'm about to sell something next few months, can I sell it for the 5th of April 2015 and use my £11,000 tax-free allowance? Because if you don't use it, you'll lose it. It's not carried forward. So the timing of those sales could be really important in terms of tax. The fourth thing I want to talk about is child benefit. And the thing with child benefit is that you do start to lose child benefit if your incomes go above a certain level, and that level's £50,000. So it is worth thinking about the earnings of you or your spouse or the other parents of your children, and how they fit around that threshold. Because the way it works, you see, is if either of you go above £50,000, you start to lose the allowance. If you get to £60,000, you lose all of your child benefit. But what that means is, because it's either of you, if there are 2 of you and there's a way of splitting income, you could both earn £49,999 and keep all your child benefit. But if one of you, say, you know, there's an extreme earning nothing and the other one's earning £60,000, you've lost it all. So therefore, if you have any income that can be split, just think about that. So as an example, if there are rental properties, if you have shares in a limited company and you can split the shareholdings, just to try and keep both of you below that limit, the £50,000, and keep the child benefits. And my 5th tip actually is very similar, because really it's all in the timing, and with the end of the tax year coming up, it's just worth looking at whether you're near one of the thresholds that have a big tax impact. And the main thresholds are, the first one's at £10,000, because you get £10,000 tax-free. Therefore, if you're about to hit £10,000, it's worth thinking about. The next one after that is at £41,865, because that's where you go from being a 20% taxpayer to a 40% taxpayer. After that, I've already mentioned the child benefit one, so £50,000 has quite an impact on your child benefit and therefore your income and tax. The next one, and actually the one that actually has the biggest tax impact for some people, is when you hit £100,000. Because at that point you start to lose your personal allowance. So as well as paying tax, you're losing your tax-free allowance. So it's kind of like a double whammy and can cost people who earn between £100,000 and £120,000 are paying a lot of tax on that £20,000 of income. And the last of the thresholds for income tax is £150,000, because that's the point at which you start paying the highest rate of tax, 45%. So if your income is near any of those thresholds, it's just worth having a look at what you might do just to reduce it. An example can be putting money into a pension. Actually can help you with those thresholds as well. So those are my 5 tax tips to cut your tax bill before the end of the personal tax year. Quick recap: it was ISAs, pensions, using the allowance for both of those, the timing of selling any assets, looking at child benefits, and also the thresholds. Before you do anything though, it is always worth taking expert advice on these, because you know they do kind of interlink. It's worth just having a chat with an expert. Of course, if you would like to chat to us, please do get in touch using the details below. But overall, I hope you found this video useful. If you did, it'd be great if you could add some comments below, and of course subscribe to the channel for more tax tips in the future. So that's John Davis. Thanks for listening, and I'll see you soon.